Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, audience and listeners. This is James Kandasamy from Achieve Wealth Through Value at Real Estate Investing podcast. Today, I have Kay Kay Singh. Kay Kay Singh is a big figure in our social media circle, especially in the multifamily and multifamily syndication. Kay Kay is used to be a Microsoft certified system engineer. I like to call it MCSE because it's a pretty well-known designation for system engineers on the Microsoft world. And Kay Kay has also owned multiple business, including gas station, convenience stores, laundromat, and also he started real estate with 40 single-family residential in Indiana. And currently, he's an investor in almost 3,000 units as a LP, and in some of it is a GP across and all states in the US. And he also have done agriculture, commercial, and residential property in India, and also, business experience, almost 10 to 19 years in US. And also is also looking for expansion opportunity. Hey, Kay Kay, welcome to the show.
Hello, thank you very much, James, for having me on your show.
Sure, absolutely. So, Kay Kay, let's get started with our show. I mean, I got to know you like almost 2 years now, right? So you've been doing very well in terms of multifamily investing. Especially you started as a passive, and now you're going more into the GP, right? But I want to go before that, right? So you are on a later part of your cycle, and you did a lot of different businesses, right? Laundromat, gas station, convenience stores. And so I want to go into that businesses before we go into multifamily. And then after that, I want to compare that businesses to multifamily. And why did you, at this stage of your life, why did you want to do multifamily? Because, there's a lot of people who want to really learn these different businesses. Like I always wonder how gas stations work. I always wonder how convenience stores work. How does a laundromat work? And do they really make more money than what I'm doing right now in multifamily? So you are the best person to really tell us and our audience what are the different aspects of this business. So let's start with, you own gas station, convenience store, and laundromat. So tell us about these three businesses. How does the business work? How much people make? And what are the even in that businesses? What are the value add that you always see that is very powerful?
Well, I came to United States as you said, Microsoft certified system engineer, and I lost my job after 9/11. And it was just about 6 months before I came. So I had a job for about 6 months, and I lost my job. And my friends were in the gas station business in Indianapolis, and they offered me a partnership in the business, and they asked me to come and join their business. And so I decided, since I had no option, so I decided to join their business as a partner. It was a gas station in Indianapolis. So I started managing that. I automated because everything they were doing on papers with pen and paper. So I was a computer professional. So I did everything into computers. And soon we lost the lease because the owner did not renew the lease on that property. So I had learned the business because I had it about a year. So I bought a gas station here in Fort Wayne after about a year and a half since I came to United States.
Got it. So before we go to the other business, how does a gas station make money?
Well, the gas station owners make money mostly on the inside sales. They don't make money on the gas.
Oh, you don't make money on the gas?
That you don't make money on the gas, and most of the money is made on the convenience store side. So with first I bought one gas station, and soon I had other people join me in buying gas stations here. I was the first Punjabi to buy a gas station here in Fort Wayne. And soon I brought some of my friends, my relatives to buy gas stations here. So we formed a group and we started buying in bulk. And that way we made more money. We got more rebates. We got more kickbacks since we were buying in bulk.
So the rebate and discounts that you get, that's on the fuel price, right?
No, on the inside sales. Mostly
on the inside sale.
Yeah.
So why does every gas station have different pricing in terms of fuel?
Because you have the right to price your own gas whatever you want to. Some people like to make 5 cents. Some people like to make 3 cents. Some people like to lose money on gas.
Got it.
So
yeah, I mean, we always wonder. I mean, I'm sure. I thought every gas station owner, trying to make some profit because every gas station have different pricing. Do they try to take a bet on making more money by increasing the gas price slightly? I'm sure it's an elasticity in terms of customer demand versus the gas price, right?
Well, the street price is who rules the gas prices, the street pricing. So some people like to bring the customers in by losing money on the gas. Or making less profit on the gas, and they want to bring the customers to their lot and then bring them inside to the convenience store where they can make 35% instead of pennies.
Got it. Interesting. I thought there will be some money being made on the gas, but looks like what you're saying is if it's so little money, you may not make money or you lose money.
No money, because 90% people these days use credit cards, and then on top of that, you end up paying credit card fee as well.
Oh, so you have to pay. So, but the convenience store, is the price inside the convenience store slightly higher than what you get from Walmart or Walgreens or CVS?
Yes.
Okay, so
that's why they're called convenience stores, because they are for convenience. Yeah. So it's
convenience.
they have to pay for the convenience.
Yeah, which makes sense, right? I mean, I'm giving you space and the gas for almost all on my costs, right? And now you come and pay a bit more on the convenience store. Probably people don't care because it's convenient for them, right? That's absolutely right. That makes a lot of sense now, because I always wonder this, right? So does the gas station business being impacted with some of the electric cars that's being popular nowadays?
Well, we never made money on the gas anyways. So so I don't think it's going to affect. People still going to buy their food and drinks and chips and candy and the cigarettes. So they do still come to. I own an electric car myself, but still I stop at gas stations to
buy things,
buy coffee, buy candy, buy something.
Got it. I think the location of it is much convenient, right? I think that's how, like, even Buc-ee's, right? I'm not sure whether you know Buc-ee's in Texas. They're very big. They have a lot of gas station, like 100 gas station outside, and it's a big convenience store, right? So
Yep.
Okay, that makes sense. Yeah, so it's like a big, slightly more expensive because it's very convenient, right?
Correct.
Okay, got it. So what about a laundromat? How does that work?
Well, I had this lot sitting by my gas station for a long time. It was a vacant lot, and I thought of buying it and utilizing it. And this neighborhood needed a laundromat. There was a little, like a block away from my gas station, there was a laundromat, which was an old, beaten up laundromat. It was like a 20 years old machines. So I thought that I can utilize this property, and I did some creativity in buying that lot at a very low price. And I built a laundromat from ground up with the best machines that they come, bigger machines. So immediately after I opened that laundromat, the other one closed because it was old. Nobody wanted to go there. So and laundromat is a good business too, because you don't need employees, so it's unattended. So I have a girl that comes in the evening and cleans up, and somebody will go from the gas station and clean up, or if there is any problem. So this is kind of a passive income.
So you still have the laundromat until now?
Yes, I do. And we are building another one.
Oh, that's awesome. That's awesome. So is this a machine with a Speed Queen?
No, Dexter machines.
That's so. Okay. Okay. So
Dexter, we have bigger machines like 90 pounders, 60 pounders, 50
Oh,
pounders. Yeah.
got it. Got it. I mean, the reason I asked about Speed Queen, because in my properties, I probably own a laundromat as well, but indirectly, right? In all our apartments, I think 90% of our apartments, we own our own machines. So, we like to buy, new machines, but this is for
And,
residential. So it may not
and
be
Spin
very,
Queen is good too.
okay. Okay.
But Dexter is good for laundromats, commercial, and it's very simple to operate. And it's a sturdy machine as well.
Got it. And have you ever tried to sell this gas station and the laundromat?
No.
Okay, so you're keeping it for passive
No.
income.
I have a system in place, and they are on autopilot. I mean, so because I have partners in all my gas stations, they run the gas stations, and I stay home.
Okay, good. That's true passive income, right? So,
Yeah.
no, the reason I asked you whether if you sold, because I want to know how this business are being valued.
No, I have never sold any gas station. I have always bought gas station, and I
Okay.
would still buy a gas station if I have to or get a good deal.
So if it's passive income, why not you buy nationwide?
No, it's not passive income. It's
Okay.
not. It's passive income for me because I have my friends and family as partners who run the businesses for me. It's not passive income, and I don't. People call me all the time and ask me if they can buy a gas station and rent it out and make more money than single family or real estate. No, it's not business. It's not like that.
So it's not as passive as what I'm trying to say, I guess.
It's not at all passive. It's just autopilot for me because I've done this for so many years and I have brought in partners and some of them were even my employees that I have partnered with.
Got it. Got it. So they are the one who's active and you are investing money and for you it's passive. So it's not really passive income, but because you are a silent partner, you get passive income, I guess. Okay.
Correct.
So after that, how did you buy 40 single family residential?
Well, I met, the seller was from our community. He met me at the church and he said, I want to sell my property that he had for several years. And I told him that I know somebody in Indianapolis that I can refer to. And he said, no, I want to sell them to you. And I said, no, I have never done this. And I'm not going to get into a rent business, toilet and all that kind of stuff. He said, I will give you a good deal and I will teach you for a year how to do it. So that attracted me. And I came home and talked to my nephew. And at that time, I didn't even know what cap rate is. So I talked to my nephew. We calculated, we didn't get any financials or anything from him. And we were comparing. I went online to the city website and checked the prices compared to what he was offering us. So I liked the pricing and everything. I said yes. The very next day, I said yes. We'll buy your houses, and we went ahead and bought. We never hired an attorney. We just wrote a purchase agreement on my computer, and we bought those 40 single family houses. And then he started helping me, but he had done this for about 40 years now. So, but he was all old school. Everything was on pen and paper. I didn't like that idea. So I had a lot of other stuff going on. I said, no, I would do it myself. So I bought some books. I went online, did some research and started managing myself. And I still manage those 40 single families myself.
That's very inspiring story, right? Because where you go in from zero to nothing, I mean, to learning about how to operate 40 single family residential. So how did you learn to to make that business in single family residential from, the guy who's selling you, he's old school, right? So
Yes.
you are Microsoft certified system engineer. You are going to think on how to put everything into computer. What was the first website or resource that you used to start managing this 40 single family residential?
Well, first of all, I started researching about the property management software. And I did some research on the property management softwares, and I found buildium.com the best software for my purpose. And the pricing was good, the features were good, and I signed up for a demo. I took a demo and liked it, and I moved all my properties to Buildium.
Got it. I use Buildium as well for my single family residential. Even though I only own like 2 right now, but we went through a few iteration of property management software for single family and then settled on Buildium, which is pretty good for the single family, rental management. Got it.
Correct.
So you are in Indiana, right? So have you ever thought about looking other places for real estate, or you just you wanted to do that?
No, I do my multifamily almost. I have one in Indianapolis, and all others are out of Indiana.
Got it.
So right now I'm doing the 10th deal as a general partner, and I did 7 deals as a passive investor. So all of them, but one is in Indiana, and all of them are out of Indiana.
Okay, got it. So I want to go to that transition where you were doing laundromat, gas station, and 40 single family residential. So how did you get introduced to multifamily apartments?
Well, when I bought these single family houses and I went online I started researching on bigger pockets and read some books, and I realized that it's not scalable, and especially there's no tax advantage. That's why we bought these properties. We thought, we're going to save money on tax because we were paying a lot of tax. We had a lot of cash flow from the gas stations. So we were paying a lot of tax. But with buying single family, we ended up paying more tax because we made more money. So I thought, no, we were here to save on taxes. So this is not the way to do it. So I started researching, and finally I learned about the syndication process and cost segregation, how people save money on the tax. So we started, and I actually started investing passively, and never thought I'm going to be active investor at that time because I had so much going on, and I have like 15 companies. So I thought, okay, I'm keep doing it, but I'll keep investing my money passively and get K1 losses and wash off my other passive incomes. That was my original plan. But when I started learning about multifamily, and I learned that I have so much passion about multifamily, so why not do it actively?
Yeah. No. So I want to go through your thought process here. So at what year was it that you discovered multifamily?
2015.
2015, which is like what, 4 years ago?
4 years ago.
And you said syndication, right? So even when you introduced to multifamily, did you look at buying a multifamily without syndication?
Yes, we did. We did 4 times.
So you did buy some multifamily without syndication?
No, we didn't buy any.
Oh, you didn't buy?
Because we were thinking of buying the same way we bought these houses.
Got it.
So we didn't even know how to do underwriting, how to calculate the profit and loss. So we thought, okay, we bought these houses for so much, and these are like just 2-room, 1-bedroom apartments. So they should be half the price of the houses. So that's how we started, and we offered 4 LOIs. First, we started with the 32 unit, and we went all the way to 96 units to buy. But every time we were overbid by others, and we didn't know that we have to do underwriting and all that stuff. That I realized after giving 4 LOIs that this is not the way to do it. We need to start underwriting, and they are not priced as the houses are. They are priced on based on the net operating income. Then I started learning all that in 2015, and as I was learning, I was investing passively as well.
Got it.
I still kept investing, and a couple of my partners started investing along with me too. So we invested all over the nation in first 3 years, 15, 16, 17. And in 18, I decided to go active.
Got it. Why you didn't, from single family, when you were thinking of buying the large multifamily, which is like 40, 50, 90 units, right? Why you didn't look at duplexes, triplexes, and fourplexes?
Oh, I thought duplex, triplex is the same thing as single family, because we had the money, we had the resources, we could get the loan, we had the net worth, so we thought we can buy 30, 40 units. We never thought of buying smaller property.
Okay, so you wanted to go big because
Big.
you think you can do it. It's just that you didn't have the knowledge on how do people underwrite these commercial properties, right? Commercial.
And that I learned soon. After being overbid in 4 of those LOIs that we did present. So I decided to learn, and then I learned a lot. And I attended several boot camps and took some courses, read a lot of books, listened to a lot of podcasts. So actually, I had a passion for it. So I was spending like 5-6 hours a day, maybe even more, maybe 8 hours a day, just learning about multifamily. For 6 months, I never slept before midnight. For 6 months.
For 6 months, you didn't sleep before midnight because you were so wowed with this multifamily?
Yes. That's when I was learning about it, listening to podcasts. Every night I would listen to podcasts, read something about. So I spent a lot of time learning this process.
And you said multifamily was more interesting compared to buying more gas station, laundromat, and single family because of the tax advantage, right? That's what you're saying. So you need something to offset your passive business, active business income, I guess.
Well, I had a lot of passive income as well because I was not active in all the gas stations. I was passive in some gas stations, and we own real estates of several gas stations. And those LLC owned properties. And so our operating companies were paying rent to the real estate company. So that was my passive income as well.
Oh, got it. That's an interesting strategy there. So why not you buy like a strip mall or warehouse or industrial warehouse or self-storage?
I don't like anything else but multifamily.
Why? Did you look at that asset classes?
Yes, I did look at it. It's on my criteria as well. The second thing I would ever buy would be storage units or the mobile parks. But I would never go to commercial or anything because I know people need at least a roof to live somewhere.
Okay, got it. So you think there's a definite need for a residential?
Yeah, because of the technology, you never know. You see these strip malls, commercial buildings closing, industries moving to Mexico, China, India, and all those countries, but they can move apartments to China.
That's right.
So they have to live here. So that's the only. I get a lot of other offers, but I am very, very strictly multifamily person.
Yeah. So let me give some education to the listeners. So what Kay Kay was talking about is the tax advantage that you get in multifamily, especially with something called a depreciation, which is a paper loss, which shows your income, even though you're making cash flow from positive cash flow from your operation in apartments. Depreciation is going to be more. Most of the time, it's going to be more than your cash flow, which means it shows as you're losing money, which means you probably don't pay any tax on your cash flow, right? And sometimes net cash flow minus depreciation do come out positive, but the amount will be low because now you have depreciation. And in single family residential houses, you still do have depreciation, but it's divided by 27.5. But in commercial, which is apartment, rather than doing divide by 27.5, you can still do 27.5, but you can also do something called cost segregation, which means they segregate each part of the building on commercial into 5 years, 7 years, 15 years, and 27.5 years, right? They separate the windows to 7 years. I do not know what exactly is the schedule, but example, windows to 7 years, the driveway to 15 years, the flooring to 5 years. And what they do is they said all this 15 years, for all 5 years, everything is segregated, and all this depreciation is accelerated in the first 5 to 7 years and 15 years. And even the first 5 years is like 30% of total depreciation. So the amount of depreciation you get in apartments is like, it can be huge because of this cost segregation, right? And now with the tax law that we have in 2017, from 2017 to 2023, you have something called bonus depreciation, which means you're going to take all the 15-year schedule of depreciation, you're going to depreciate it in the first year, which used to be only available for new development, right? Which makes sense, right? New developments, everything done, you depreciate 15 years into it. But now the new tax law have given leverage for the properties that has already been built. But this advantage only available until 2023. And after that, it start reducing to 50%. Instead of 100% depreciation, become 50% and it depreciate less, right? And in other commercial real estate, like strip center and warehouses and all that, is not depreciated by 27.5, it's depreciated by 39 years. So you can
39
buy
and a half.
Come again?
39 and a half.
39 and a half. Okay, thanks for clarifying. I thought it's 39. So 39 and a half. And what happened is, you get much lower depreciation. They can do also cost segregation, but you're going to get less number, right? And it makes perfect sense for apartment because of the Maslow hierarchy of needs as well. Everybody needs a shelter to stay, right?
And especially because of those appliances they have, the kitchens, the counters, kitchens, fridge, refrigerator, microwave, and the stove, those things get depreciated in the very first 5 years, and you can get all that in the very first year.
Yes, correct. So that's an awesome tax strategy in apartments and what we call as multifamily apartments. So let's go ahead. So you said you started learning how to value the apartment, and at 2015 you learned the trick of the trade, right? So why not at that time go and buy apartments? Why did you go passive?
Well, at that time, I was still managing the laundromat and one gas station myself. And after about 2 years, in 17, my daughter got married in 2015, and her husband came to United States in 2017. I asked him, he was a computer engineer too. I asked him what he wants to do. And he said, I want to be in the business. He owned a gas station in Canada as well. So he migrated from Canada. So he started doing what I was doing. So I was only managing these 40 single family houses, and most of my stuff was on autopilot. So I had nothing else to do. I decided to go active. So that's when I started looking to do a syndication myself.
Okay. No, but my question was like, after you learn all the tricks on how to underwrite multifamily, right? Why did you still go with passive investment?
That's why, because I was busy managing my gas station, single family houses, and laundromat myself. So
so now your son-in-law is taking care of that. Now you. Okay,
yep.
Got it.
Yep.
So now you have all the time to really be an active sponsor, I guess, right? So
correct.
Okay. How did you make that transition from being a passive to active? Because that's a day and night scales.
And you should know that too, because you were sitting on my this right hand side, and Jeff Greenberg, he was sitting on my left hand side, and San Diego Mastermind.
Oh, I must have influenced you.
Yeah, and something came. I pulled some of your power, and Jeff offered me to be a general partner on his deal.
That must be my lucky.
Yeah. So I said, okay, I will be a general partner. I raised money for his deal to close. So that was my first transition, and I was so much motivated by meeting all those people at the Mastermind in San Diego last March when I did the deal.
Yeah, that's very interesting. Sometimes this Mastermind brings, it's the proximity is power, right? You have people who are doing it, and that you can do it if you have the right support, right? And sometimes certain words and certain discussions can motivate you to progress. So it's a very, very powerful concept of mastermind. Sometimes people thinks that you go for mastermind, you are wasting time, right? You're talking, right? But there is always influencers, especially in a small settings, right? Compared to going to like these large conferences where you go and just network, right? It's not so contagious, but in a small group settings can be contagious, and that's good. So you're able to, yeah, I know when we were in the mastermind, we were talking about you are passive, and
Yep.
I didn't know that was the time that you were transitioning. You decided to transition to a GP.
The same day I did it, and he emailed all the information. And when I was coming from San Diego, I was looking at the CoStar report, underwriting, and everything on the plane from San Diego to Chicago all night.
Got it. I have to give credit to myself to influence.
Yes, you do. Yeah, the credit goes to you too.
That's good. That's good. I hope so. I mean, I'm sure you would have some calling for you as well. But I think, I'm happy to help out as well.
Yeah.
So, KK, what was your discovery when you, from a passive investor? I mean, you were before. Let's assume that mastermind was the transition period. At that point, before that, you were a passive investor. Your mindset is completely different, right? You just want to invest passively. You do not want to do any active role. Maybe it's fun, it's interesting, but you just do not want to do it. But once you step over into the GP side where you partner with another sponsor, right? So how do you think your mindset has changed from passive to become an active?
Well, my mindset changed back in 2017 because I had learned so much. I was thinking, why don't I put all this knowledge to work? Why I'm just investing passively? But as I told you that when he took over, so I was completely free, and I stayed home, and there was not much, and I have so much my single family management on autopilot that I spend about 9 hours a week. So I had nothing else to do, and I decided to move on to, and I started looking on deals. I before my mastermind, I did started looking deals, and I did some tours of the properties, and I did give some LOIs as well, and I learned the business practically by doing it. Then it was I think a miracle happened when you did something at the mastermind that I got a deal. And I also learned that it is a teamwork. It's not something that I can do myself. It is a teamwork. So I think that was a great opportunity for me when Jeff offered me that deal, and they were very close to the closing. So I raised the money in about 3 days and became a member of his asset management team, where I learned a lot as well. And after that, I did one deal with Rodcliffe and Robert in Lexington, Kentucky in May. We closed that in May. And now I'm on a general partner on a deal with Viking Capital, 192 unit, a B-class asset in Marietta, Georgia, north of Atlanta.
Got it. So let's assume, KK, so now you have moved to become more on the active side, right? Part of the asset management team. Mm-hmm. So if I split you into two, your best friend is your older Kay Kay Singh as the passive investor, and now is the right on the right side is Kay Kay Singh, the active investor. What would you turn to your passive investor best friend and say, what are the advice that you want to give to your Kay Kay Singh, passive investor, on how to invest smartly as a passive investor, since now you know both sides?
Well, even when I was passively investing, I was learning continuously, because the very first deal, I didn't know much about multifamily. So I just invested to see how it works. So I just wrote a check to Ivan Barrett for $50,000, and I invested in his deal in Dayton, Ohio. And but after that, I realized that I need to learn about the passive as well. And I like reading a lot, listening, reading. And so I started learning how to invest passively. And I prepared a list of like 42 questions, which I was asking. And then I started investing with Joe Fairless in his deals in Dallas. And I didn't want to put all eggs in the same basket. So I tried some other syndicators, other markets as well, before I finally decided to go active.
Got it. So can you, out of that 40 questions that you have in your passive investor checklist, and don't worry, I'm not going to ask you to do all the 40 questions, but is there any like 5 to 10 questions you think all passive investors should ask before investing in any deals?
I think the most important thing is in all this syndication process is the operator. So I always even tell my investors the same thing that I did myself. I always looked at the operator. Who is the operator? Who is their team? Do they have an office? Do they have a complete setup? And then do they have a track record? Have they gone through a full cycle? So I always look at that first. Even as a passive investor, even as a general partner, I do the same thing. So, and the second thing is the market. What market? What market is the property in? So, does that property market has a rent growth, continuous rent growth? Does that market have a continuous population growth? Are the companies moving to that area? Is it a bigger like population over 200,000? I don't invest in smaller cities. So those are the second things, and then I move on to the property. Is it really a value-add property? Every property says value-add property. Sometimes there's no value-add or there's no rent growth. I have seen like people would write 300 rent bump. Do you think the previous owner was dumb? So he was $300 below market. It doesn't happen all the time. So I prepared a list of questions. I learned how to do all the comps, sales comps, rent comps. So and I educate my investor do the same thing as well.
Got it. So what you're talking about is operator, the second is the market, third is the deal, which is absolutely the right priority. So let's say for a new passive investor, right? How do they find about, before we go there, can you define what an operator is?
Well, operator is the guy who finds the deal, brings it under contract, signs the loan, or bring the team together, or if they already have the team, and then after the closing, they operate. They make sure they are performing as per the pro forma. The property management in place is working, doing a good job, and they are giving the reports quarterly or monthly, whatever information to the investors, and also paying the investors as promised.
Got it. So how can a passive investor know about the operator? I mean, without asking the operator directly, because sometimes I know, right now, sometimes it's hard to know. I mean, let's say a new passive investor come, sometimes, they are very shy to ask a lot of questions because they are worried that they will not get into the deal. But is there any other way that a new passive investor can find out about the operator without asking the operator directly?
Well, they shouldn't be shy. I even ask the operator, if you die, I go that far. If you die,
Okay.
I mean,
that's true.
should.
Yeah, absolutely.
And I don't mind if somebody asks me, if you die, where are we going? To ask for our preferred return or money. I mean, it's obvious if somebody could die in a second.
Yep.
So there has to be some things in place that if somebody dies, who's going to take care? So I think that should be, and I have uploaded those 42 questions on my 10x Facebook group several times, and Rod Cleef has those 42 questions on his website. I think passive investors should download there as well. But I can tell you how people find me, because they follow me everywhere on social media. they check my profiles and they listen to my podcast, and then they approach me. How we know you for a year or two? I saw your video or live or podcast. So they probably know everything before they come and contact me, unless they are referred to me by someone who is already in my investor or my friend. So they trust me too.
Got it. Yeah, I mean, that's true. I mean, once you are...
I'm very active on social media, so people know what I do.
Yes. Correct. So what about market? Can you tell the audience, especially passive investor, any specific resources they can go and see before investing on the market? I mean, I know you said you do not want smaller cities, you want big cities, but what else they should look for in a market before they even invest, even passively, right?
Well, they should, first of all, we talked about the operator, and then the market research is very important. They should look at, there are so much free services available, where city data is one of them. They can go to
citydata.net,
citydata.com.
Okay.
.com, and they can go there and at least, or just write down population, and there will be a population of so and so city. They'll get so much information, and there's another world review website that it will automatically pop up under the city data, and you can go there, research the market, sub-market, and even the neighborhood.
Got it. So have you seen any deals that was presented to you when you are a passive investor, when you presented to you that you think, this guy, he didn't underwrite the deal as conservatively as he's claiming. I mean, everybody claims their underwriting is conservative,
all the time,
right?
All the time.
It's like a value add, right? All deals are value add. Same thing, all lead sponsors, all our sponsors are saying all their deals are written conservatively. We'll fill up quickly. Right. So
some people are very smart to write their OMs, okay, and they will write it in such a way that a passive investor who is not very literate about the multifamily, and if they don't have time to do their own research, they can fall in that net very easily, because they are written so smartly. So they don't understand, and they don't spend much time either.
Yeah. Can you give us a few examples where you are able to caught some, I would say,
the biggest one is the comps.
It's the comps. Okay.
Comps. And the second thing is the rent growth. Sometimes they'll write 3% rent growth, and they will say, it's very, very conservatively written. And I have been managing these houses since 2014. I have never seen 3% going up every year. I mean, there has to be some year when it's going to be down. It might go up to 3% again, but all 5 or 7 years or 10 years, whatever the whole time is, they don't go up all the time. And another thing is the vacancy. A lot of times they will write the vacancy, we're gonna have it 95% occupied. But when you look at the CoStar report or other resources, the market occupancy is at 90%. So how can you do it 95% if the market is at 90%? So some of those assumptions they make are sometimes very aggressive.
Got it. So you say RANCOM, and you also talked about the comps, right? So are you talking about the RANCOM that they are projecting?
Rent comps. They are projecting. Sometimes I have seen on the OMs, they are not comparing apples to apples. They're comparing 1 bedroom to 3 bedroom. And then they'll say, there is a $315 rent bump. You're not comparing apples to apples.
Do you think they make a mistake, or they just
they intentionally do it? And nobody can challenge that either, because they say nothing there that it is 3 bedroom compared to 1 bedroom. So that OM doesn't say that we are comparing 1 bedroom. It's just going to say that apartment has this rent and this apartment has this rent, and they'll show you that there is a $300 bump, and which is not true. So far, I have never seen a bump more than $150.
Even 150 is difficult to get, right?
I mean, no more than $150. I have seen up to $150, and which is also, as you said, by renovating, adding like $5,000-$6,000 to the unit, you might be able to raise the rent by $150 maximum.
Got it. Very interesting. So, was there any aha moment as a active sponsor, as an active person more on the GP side now that you think, like in the past 6 to 8 months, that you think, I've learned something new about multifamily? Can you share it with the audience?
I always learn every day. Every day I get some new experiences. I learn new things sometimes even from people who know nothing about multifamily, but sometimes they teach you good. And I am very motivational, and I am motivated myself. I try to motivate my members in my 10X group as well. But every day you learn in this business. Every day you learn some things new.
Got it. So you have been pretty successful in in investing into multifamily, and now you're going to more into the GP, right? So what do you think is the most three, I would say, secret sauce to your success?
First of all, and I would also suggest to your audience, which I didn't do, but I didn't have to pay the price, but somebody might end up paying the price. I would say invest in yourself. That means learn the process yourself before you invest in any real estate. It could be single family, multifamily, any kind of real estate. Do your homework first, and don't be scared to spend some money on yourself. Your personal development and learning and boot camps, those are really helpful. And when I started learning at Bigger Pockets always said that you don't have to have a coach, you don't have to attend any boot camps and everything. But when I got out of that mindset, I said, no, I got to go check out some boot camps. It doesn't matter if I have to spend some money. And I realized that I learned a lot. I got motivated a lot. And also then I was holding myself accountable to do something. So it's before that, it was free flow. So whatever I could do, if I got a deal, I would go ahead and make an appointment, go look at that deal and end up there. But I think these things help, these Facebook groups, these masterminds, these boot camps, all these real estate multifamily events, all of them help.
Got it. So it helps in terms of giving you some guidance to move ahead, or give you some motivation, or how does it, or give you some knowledge or context?
So as long as you have knowledge, you feel very comfortable doing something. If you
Got it.
If you get out of your comfort zone and have knowledge, and once you have the knowledge, you feel very comfortable doing anything. If you don't have knowledge, you always in fear, you got scared. Oh, what if I do this wrong? What if I can't raise the money? So there's a lot of questions. Once you have the knowledge, you know that you will be able to do this. If you have a good deal, the money will come. And I hear a lot of people saying here on Facebook as well, that a lot of people say that if you have a deal, money will come. We have a deal, but we can't raise the money. So that means something is wrong with your deal.
Especially on this market cycle, right, where there's a lot of capital chasing the small number of deals, the true deals, right? I mean, there are a lot of deals, but most deals are, 98% of the deals doesn't really underwrite well as what it used to be, right? I mean,
exactly. I was looking at underwriting yesterday. This property had, but since 2015, the occupancy is 60,000, and all of a sudden now it's on sale. It's at 90%. I looked at the CoStar report. I said, what? Within the last 3 months, it went up from 60% to 90%. I looked at this deal yesterday, and since 2015, I looked at the CoStar report, and since 2015, the occupancy was at 60%. And in the last 4 months, it went from 60 to 90% because now it's on sale.
On sale, yeah, correct. You have to be very, very careful about this kind of deals. I mean, unless it's an experienced operator, you are ready to go and turn it around. Otherwise, it's just going to be difficult to once you take over, right?
And I think they already offered a little bit more money, but now the broker wants them to raise their price. I said, don't even raise a penny. Whatever you have offered is already on the higher side. But a lot of times they want that kind of money, and they can get because somebody else will pay. And I told this guy that somebody else will pay more, but they're going to be in trouble.
Correct. I mean, market is saving a lot of people out there right now, right? I mean, a lot of people have overpaid in deals and made a lot of mistakes in the underwriting, but market has been saving a lot of them for the past 9 years, right? I mean, rising tide raises all ships, right? So it's okay to make mistakes now, but it may not be okay when the market turns, right? Because now, you will see who's in trouble once the tide come down, right? So you have to be very, very careful right now.
The market is at its peak now, turning to slow down. So people should be very careful.
Got it.
And they should do their sensitivity analysis as well, do the stress testing on their deals to make sure that they will survive if the market softens a little bit.
Got it. So KK, is there any proud moment in your life, in your business life, that you think you cannot forget? That's going to be, that if you really think, in next 10 years, one proud moment that you think that, you're always really proud that you did something.
I think I have been always proud of what I did because I do my homework before I do anything. I'd spend a lot of time researching. When I built a laundromat, I'd spent about a year the same way. And I'm very proud that I spent that time. And I'm making a lot of money on that laundromat. And it's a very successful business.
Got it. So you're proud that you're doing a lot of research before you entering into a new venture, right? So
Correct.
Got it. And if you want to let our audience know how to find you.
I'm very easy to find. They can go to Facebook, and I have a Facebook group, 10X Multifamily Investment Group, and we have a little over 3,000 members in about 6 months. I think we started the group at the same time.
Yeah.
I started
slightly late, but you're slightly ahead of our group right now.
Yeah, and that's where they can find me. They can ask me questions, and every Tuesday I have a Zoom call where they can come and join us and learn something, network, and they can ask me questions as well, face to face. Every Tuesday, 9 o'clock Eastern time. And the Zoom link is always in the 10X Facebook group. And then they can reach me through our website as well, growrichcapital.com, or they can call me on my cell phone, 260-341-1964.
All right. Sounds good. So KK, thanks for coming for the show. You add a lot of value. I think I really found a lot of nuggets because you moved from different businesses to multifamily. I think that would be very helpful because a lot of listeners could be doing other businesses and always wonder why not that business, why not this business, right? And then why multifamily? So I think you summarized it pretty well. And I think I did get a golden nugget of, a few golden nugget when you move from passive to active, right? And how that transition worked out and your thought process when you go through that whole process. So appreciate you coming on board. Thanks for coming. And that's it.
Thank you very much for having me, James.
You're most welcome. Thanks, KK.
Love to be back on your show again sometimes when I'm a bigger syndicator.
You are already a big syndicator. Thanks, KK.
Thank you.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.